Okay. Thank you, everyone, for attending tonight's seminar. We have Dr. Joanne Feeney. I'm very honored to have her on here with us tonight. We have done this before with Dr. Feeney, so thank you so much for updating us again on the markets and what's happening with there. So we will dive deeply into what she's thinking is going on with the markets and what we project happening in the coming months. But before I do that and introduce her in more detail, I do want to go over where Dr. Feeney and Advisors Capital Management resides in my master proprietary process. So if you all remember me talking about this, or if you're new to me, my master proprietary process covers every investment that's on the planet. So M is the market, A is alternatives, and S is safe money. So M is the market. That's where Dr. Feeney resides. Stocks, bonds, and mutual funds, anything that's traded. So I love to bring this to the market because a lot of times I do have seminars on alternative investments. Those are real estate or private placements, or safe money. Those are annuities or insured products. But I like to bring the market data to the table here. And I love doing it through Dr. Feeney because she's so wise and thorough in how she thinks about things and forward thinking. So anyway, I wanted to show you all where Dr. Feeney is going to be talking that red section tonight in my master proprietary process. And then those of you that are brand new to me, I just wanted to go over how we meet with people. Establishing and defining a relationship is that first meeting I have. So that's me asking you a lot of questions, collecting data from you, finding out what you want to do. What assets do you have? How can I help you get there? So that's me gathering that information together. I'm going to take that back to my office and analyze it and evaluate it for you. And then I will have another meeting with you to develop and present those recommendations I come up with for you. And then if we decide we want to work together, great, we'll implement the plan. And then the most important part here is number 6, monitor regularly. So I do that quite a bit because I want you to know what's going on with your portfolio. You don't have to know the nitty gritty. I can certainly go there if you like, but monitoring regularly, having these kinds of seminars I'm going to have tonight with Dr. Feeney, very important to keep you updated with the markets, keep you updated with your portfolio, what's happening with it. So I think it's really important, that number 6. And unfortunately, some advisors don't do that. They don't stay in touch with their clients. And I'm very well known at doing that. So with that, I'm going to go back to my first slide here. So let me introduce Dr. Feeney, and then Dr. Feeney, I will give you your slides to start doing. But Dr. Feeney, one of my very dear friends, is a portfolio manager for Advisors Capital Management and manages the growth and balanced portfolios. She serves as a member of the investment committee and also has made multiple appearances on Bloomberg, CNBC, and Fox News. And I will say, every once in a while, I'm watching Fox Business, and there's Dr. Feeney. So I'd love to see you on there. So I consider her my economic guru. So thank you, Dr. Feeney, for joining us this evening. Really appreciate it. So with that, I'll toss it over to you. Do you want to share your slides?
Sure. Thanks, Kelly. It's always good to be back chatting with you about what's going on in the markets and the economy. I will take over the screen here. So thanks again, Kelly. It's always great to be with you. I have some slides here that I think will help your folks see what's going on with the markets. We're going to think about this as sort of a review of what happened in the first half of 2023 and how we got here, and what we see shaping up for the second half of 23, which is underway with earnings season. So again, where we are, how did we get here, what's going on in the economy, what is the investing environment, and how does one position portfolios in this kind of a situation? So first, this is a snapshot. It goes roughly through the end of the first half of the year. Not only is the S&P 500, up nicely this recent in the last few months since really the beginning of the year, but earnings expectations aren't quite as sad as some folks expected them to be this year. So that rebound a little bit in earnings outlooks has really helped power the S&P higher. However, it's all not quite as rosy as that picture made it look. In fact, the increase in the S&P has been very narrow. Total return, again, through the first half roughly is about 15.4% on the S&P 500, but the vast majority of that came from 7 companies. I call them the Super 7. They include Apple, Microsoft, Amazon, NVIDIA, Alphabet, Tesla, and Meta. There are 8 stocks associated with those 7 companies because Google has 2 tickers, Goog and Google. for those of you that don't know. So the Super 7, as I call them, accounted for the vast majority of that 15.4% increase in the S&P. The rest of the market, the other 492 stocks, were up only 3.4% on average. And that tells you something about what investors are thinking about the market. And it tells you specifically that they're worried, that investors are being cautious about the market because they're worried about recession coming someday. As many people have put it, this is the most anticipated recession we've never had. It is yet to be determined whether we will have one. Our forecast at Advisors Capital keeps getting pushed out. We don't expect to see a recession in the next 3 to 6 months. We may see one, though, at the beginning of 2024. The markets that we look at to monitor the risk of recession goes everywhere from trade markets to financial markets to the housing markets to the technology space to the services sector, and then looks underneath that at the underlying strength in consumer, the household budgets, for example, government budgets, and firm cash balances. So we're looking deep at the economic data as well as the market data to try to make these assessments on whether we're likely to hit a recession anytime soon. But the good news is that there's nothing that's really broken in the economy right now. The only thing that we have a slight concern about is in the commercial real estate market. But even there, one can select stocks that aren't right in the middle of that bullseye. The question is there going to be contagion if that market continues to falter? So that's something we're watching. But to go back to this question of what has happened in the market, be aware that, again, it's been driven higher by 7 companies. And of those 7 companies and their 8 stocks, the weighted average appreciation was 64%. So practically all of the increase in the S&P 500 has come from a mere 7 companies. And those companies and their 8 stocks amount to about a quarter of the entire market. Because the S&P 500, as you're aware, is a market capitalization weighted index, as opposed to a simple index of equal weighted stocks. Worth looking at the difference of those 2 things. Another way to see what's going on is to look at the NASDAQ, which is the line in yellow here, as compared to the S&P 500, which is in white, and compare that to the equal weighted version of the S&P 500. As you can see, again, this date is a little bit about a few days earlier than the last picture. So back then it was, again, market was up 13% in appreciation terms. The NASDAQ was up 28%, and the average stock, including the Super 7s, only up 2.5% as of, again, a few days before the end of the first half. So it's really been very narrow. And moreover, for those of you that are looking to get income out of your portfolios, and one of our most effective strategies is the balance strategy, which I know some of you folks are using and Kelley has directed you into, because the appeal there is that we're getting at least twice the dividend than the market offers by hand selecting stocks. This is meant to stabilize your portfolio. You're always going to get those dividends from companies, unless, catastrophe strikes, which it rarely does in this kind of a situation. You get the dividends. It tends to smooth out their total return. But in a period when it's the Super 7 tech and consumer discretionary stocks that take off, the portfolio is going to look like it's not doing so well. It's doing just fine in the context of dividend paying stocks. And that's what this chart shows here. The dividend payers.
Let me just add here, Joanne, I just want to make it clear, because some people don't realize exactly what you guys do. And the reason I love you guys at Advisors Capital is you buy individual stocks. You're not buying mutual funds. So they're much more specific with the types of stocks they're buying. So in this case, as she's talking about here, the dividend stocks, they're very specific at which stocks they're buying. And that makes them much more nimble. I mean, you add your thoughts here, Joanne, but I think it makes you much more nimble and able to take advantage of different market scenarios that you see.
That's right, Kelley. We really do hand select. We own about 40 to 50 stocks in any one person's portfolio. So we're hand picking those stocks to capture what we think is going on in the economy, what we think is going on with the pattern of consumer spending, for example. And looking for companies that have particularly high quality. They have really solid balance sheets. They're able to pay their dividend. They're able to raise their dividend over time. And if you notice the dividend paying indices, right, which is, look at the orange one here in the middle, it's much more stable. And it's underperforming recently only because the market's been driven up by 7 companies. Normally, that's not the case. Over the long term, you'll find that the dividend payers keep up pretty well with the rest of the market, but they provide more stability, and that's what we're really after here. So if you look at your portfolio and it's not doing as well as the S&P 500 year to date, it's because we don't want to own as much of those 7 companies as is in the index, because then you're really, really not diversified.
Yeah, you're
And when
taking more
these
risk
things
too.
slow down, it's going to hurt. Yeah.
Yeah, you're taking more risk when you're doing that too.
Absolutely. Absolutely. And right now, when you look at the market, it looks kind of expensive. And so that's where our hand-picking companies really helps. We can avoid the most expensive stocks, which is what we do, both in growth and in balanced. And, you know, the market looks expensive. That's a little bit misconstrued because it's being dragged higher by those 7 companies. And those companies tend to have stocks that look expensive relative to others. So the market's not quite as expensive as it looks if you can hand pick the stocks that you own in your portfolio. One of the things we also noticed in the first half of the year is that the S&P went up a lot. The average stock, which is that equal weighted, did not go up much. And moreover, those high dividend stocks really have underperformed because they did so well last year. Those are the energy companies. Those are the financials, right? They will come back. And there's always bits of cycles in the market. So one has to be able to ride these things out. And then it's really been a story of the tech stocks. The other thing we noticed is that things really changed from the first quarter to the second quarter. This quarter to date reflects the second quarter primarily. Financials really got hit in the first quarter, but look how much they started to bounce back. They reversed that negative move. Now they're in positive territory. Same thing with healthcare, which had done really well last year. Took a quarter off in the first quarter, but now it's starting to bounce back again as people realize that the valuations over there have become particularly attractive. And the things that did really well, slowed down a little bit from the first to the second quarters of the beginning of this year, like consumer discretionary, like consumer communication services, and like infotech. It's really that first quarter, and we can talk a little bit more about that, but it comes down to investors finally saying, okay, there's likely going to be a recession. What can I buy that will deliver growth? What can I own if there's a recession coming that will still deliver earnings growth? And then what people found was things related to technology and consumer discretionary, particularly related to artificial intelligence, which is the new big watchword out there for a good reason, because it is going to spawn and has already begun to spawn hosts of new applications rolled out not just to consumers, rolled out inside companies to make what they do more efficient, more powerful, smarter, and is going to drive higher profits across the economy. But right now, the ones that are benefiting are the ones that are delivering the AI capability. Foundational to that are companies like NVIDIA, which we own in the growth strategy, and companies like Broadcom, which we own both in growth and in balanced, which enable the use of AI across the economy. So that's really what's charged up these markets. That's why we've had 7 companies outperform. But we care about a lot more than that. We also care about the fixed income market. And that's been a lot more well-behaved this year than it was last year. And this is the 10-year Treasury rate has sort of flattened out. It's around 3.7, 3.8%. It's been a little bit volatile as expectations of what the Fed is going to do have moved around. And similarly, the investment grade bond fund has, fell a lot last year as rates went up, but it's really stabilized now. So that role of fixed income in your portfolios that we use in balanced, right, as a stabilizer to generate some income and keep the portfolio well grounded in terms of its principal value is doing what it's supposed to do once again. It's a stabilizer providing nice income. And over there, by the way, we also handpick the particular bonds that we want to own. We look carefully at their credit quality. And that's why last year we were able to outperform the bond market so dramatically, was because of that hand selection of credits. So, overall, the future doesn't look so bad. This is economists' forecast of the next few years. GDP positive, consumer spending positive. These are growth rates. Inflation coming down back towards that 2% target. Right? Unemployment, yeah, it's likely to tick up a little bit. Is that going to be a recession, like a dramatic concern, people being thrown out of work? not so bad. 4.5% unemployment would not be such a bad thing. Bad for the person that gets unemployed, but overall for the US economy, not so bad. So this outlook, the US economy is actually pretty nice looking. We can invest in this environment, and most of the companies we own are going to do just fine. Doesn't mean their stock prices aren't going to be volatile as people worry about risks, which, always fluctuates and always creates volatility. But overall, it's a pretty decent investing environment. And the reason why it's decent is because there's been so much resilience in consumer spending. And that resilience has come from a very solid consumer balance sheet. They own homes, which have gone up in value. Yeah, coming off a little bit, but still very valuable. They have, savings deposits, which we know they built up during the pandemic, both pension funds and savings deposits and other assets. Mortgages are still most of their liabilities, and that's good. It means they're saving in the form of putting money in their houses, right? Now, the debt service ratio has come back up, but it's still nowhere near the levels it was in the 80s and 90s of the first 10 years of this century, right? It's back up to pre-COVID levels. That's the amount that households have to put towards their credit card bills and their cars and their mortgages, right? Because of the debt, the interest on the debt. And one of the reasons it's come back up is partly because they've added some debt, but mostly it's just because interest rates have gone back up. Okay. There is some concern about delinquencies on credit cards and car loans, right? Those have come back up since the time when people really paid off their credit cards during the pandemic. But even there, we're just back at pre-COVID levels. So it's not an alarming level. It's not like where we were in the run up to the great financial crisis, for example. And if I had a longer history, I could show you it's not where we were in the run up to the recessions of 2001, 2002. So nothing really alarming in the consumer at this point. But that's what people are watching. We're also seeing resilience in the housing market, right? Residential investment still remains pretty robust because there's so many people out there that want to move into a house. How single family housing starts, this is a long history from 1959, okay? You have to look at the very end to see that uptick. Housing starts have rebounded. They took a little bit of a breather when mortgage rates first jumped up, right? As the Fed started raising rates, all of a sudden people walked away from some of the contracts they had signed. They then reassessed and said, okay, I need to buy a slightly cheaper house because my mortgage is going to be more expensive. And so that's what they did. And now housing starts are growing again. We're also seeing that partly it's because the inventories are so low. You can't find a house that doesn't have multiple offers on it. We're back in that world after a little bit of a break last year. And the reason is because if any of you are out there, right, most of you probably own a house, you don't want to give up the mortgage you locked in a few years ago, which was, 3-ish or so percent to trade up to one that's 7%. So there's very little existing home inventory on the market. You want a house, you're going to have one built for you. And that's why we like a company like Lennar, which is in our growth strategy, which is a builder of single family homes. But, we're worried a little bit in watching the tightening of credit coming from banks, right? We know that after that mini banking crisis back in March that, banks had already started to tighten lending standards, and that tends to slow growth. And there's no question that that's happening. We are seeing growth slow down. Question is, does slowing growth turn into a recession? That's what we're keeping our eye on. We know consumers are borrowing more. Okay, yeah, that generally happens when they think they can pay back the debt in the future. People are more confident because they have jobs, more and more people are getting jobs, and they're borrowing more and spending. So these are things we're watching. On the business front, though, we have noticed, right, that, and we expected this to happen, that profit margins have gotten smaller, right? During the pandemic, when there was a shortage of kind of everything, right, goods, companies were able to raise prices and their costs hadn't gone up. They had to raise prices because they had too much demand coming in and they had not enough supply. So back to Econ 101, how do you clear that market? How do you make supply and demand equalize? Well, you better raise prices to curtail demand. Meantime, firms got to enjoy those higher prices. They got really nice fat profit margins, but wages have been rising. Some of those profit margins have gotten smaller over time. And so that's the decline we saw. And that's something we're still keeping an eye on here during this earnings season. And we're likely to see those declines in profit margins from last year's high levels offset some of the revenue growth that companies are seeing this year. And that's why for this this past, beginning of this year, we did see those margins offset to some degree revenue growth, and we expect that to continue. But businesses are still pretty healthy, and they're still investing in factory capacity. That's what this is, business fixed investment. That think about fixed as like fixed in place capacity, factories, that kind of thing. And they're still investing at a rate relative to GDP that's above average for the past 40 or so years. So that's a good sign, right? It doesn't look like a recession. Wages are still going up. The growth rate back in May was of 5% relative to the average over 50 years of 4% growth. That's nominal. So 5% is pretty high. Unemployment, again, down around 3.7%, much lower than average, right? So labor market's in pretty good shape, but that's sort of contributing to that inflation problem that the Fed is trying to solve. And so it is coming down. The latest number on this graph is the CPI number came down to 4.1%. It was a lot higher not long ago. So the Fed is making good progress, and they still have more work to do. And the market got this wrong earlier this year when they thought the Fed was going to be able to cut rates in the second half of 23. We never thought that. We've been trying to tell people that. I've been on Bloomberg and CNBC trying to tell people that. It's just not time yet for the Fed to cut rates when inflation is still as high as it is. So there's more work to be done. And finally, investors are getting the message. They have increased their forecasts of what interest rates are going to do this year. No, there's not going to be a cut. And that's fine. It means when there is a cut, which is probably next year, that'll be a tailwind for equity valuations. So this year, you still have high rates. It's not going to be the most exciting year for equities outside those Super 7. Okay, for the rest of us with a diversified portfolio, it's going to be kind of a moderate year. There's going to be a lot of watching of the recession risks. But in the meantime, we're going to look, especially as we go through the second half, we're going to look more and more towards what's going to happen in 2024. And that's where we think these high interest rates that we've had start to come down. And that provides a tailwind to equity valuations. And the earnings growth that we saw soften in the first quarter, where the S&P saw on average a 2% drop in earnings year over year, that's going to start to level out over the next few quarters. And in fact, we've seen expectations for earnings stop falling. These lines that are downward sloping, these are all the changes in the earnings outlook for the entire S&P 500 for 2023 on the lower line, 2024. As you see, those earnings numbers, the forecast went lower and lower and lower and lower as analysts finally recognized that the US economy was slowing. But now they flattened out. Good. And now they'll start going back up again. And so while the quarter just passed is mixed depending on the sector, energy relative to last year, a lot less in earnings, but consumer discretionary a lot better than last year. Overall, sort of in the middle, a little bit lower. The S&P earnings probably down about 5% once all the companies report. But next year, it's expected that the companies in the S&P will deliver about 12% earnings growth. 12%. Valuations tend to precede earnings growth. Investors in the second half of the year are going to be watching this carefully. And they're going to be saying, okay, is this how much earnings can go up next year? Because if so, I want part of that. I want to own those companies. Generally, stock prices go up in advance of earnings going up. And the earnings are going to go up. If they're going to go up 12%, we should see the market start to respond to that more broadly, not just these 7 companies. So in terms of our positioning in the portfolio, obviously it's going to depend on whether we're in balance or whether we're in growth. The interest rate outlook says, yeah, we're going to get some more rate increases, most likely this year. We've had a pause right back in June. We're going to get probably more increases this year. And then they probably flatten out again. And then eventually, as the inflation numbers continue to come down, the Fed will start to cut rates. And lower rates help equity valuations. So that'll be another tailwind on top of the rebound in earnings growth that looks likely to come into play in 2024. So the second half of this year looks really interesting from an appreciation perspective for stocks. Now, I know all of you guys are in it for the long term, right? You understand that owning equities is a long-term game, and that you want to go through these cycles and just have the right stocks, have the right risk exposure. But sometimes it's nice to see what might be happening over the next 6 to 12 months as well. We do expect margin compression. We do see that recession threat. We're watching it carefully. So far, consumers holding up. Job market is slowing, which is useful. Doesn't look like it's crashing yet. There are still plenty of geopolitical risks out there. The war in Ukraine, China tensions with Taiwan, China tensions with the US. So what we're doing in the portfolios is finding quality in terms of balance sheets, in terms of management discipline over using profits for reinvesting in the company, for paying dividends, for buying back shares. But we're also looking to put companies in the portfolio that have particular resilience in the face of slowdown in growth. Companies like McDonald's or TJ Maxx. These are companies that hold up well during recessions because people keep shopping there. In fact, more people go to McDonald's and go to TJ Maxx when they're facing real budget difficulties at home, because that's a good way to save money. We also have built in inflation and interest rate protection into the portfolios. We've also built in some protection against some of those geopolitical risks by owning defense stocks, by owning cybersecurity stocks, for example. And so we do expect that fixed income will, though, continue to play an important role in stabilizing the value of the portfolios, because with all of these risks, whether it's recession, path of interest rates, geopolitical, we do expect higher than average volatility through the rest of the year. And so we want to have that fixed income in there to provide that stabilizer for folks in balance. Folks that are in growth are 100% equity because you guys have that longer time horizon, you're riding out the volatility. And when we look at that volatility over the years, this is what we see. The bars are the return in that year of the S&P 500. So back in 95, it was up 34%. The red dots tell you the biggest drop within the year of the market. So 1995 only dropped 3%. You go look around 2000, 2001, the market was down 12% at one point, but it finished up 20%. Look at more recent history. Last year, the market was down at its worst was down 25%. It ended up finishing down 19%. But the year before, in the middle of that pandemic, the market had dropped 5% at one point, but it finished up 27%.
What a wonderful chart you have here. Oh my gosh. I'm
this is really useful.
Okay, this
is
such a great thing for people to look at as why you stay invested, why you don't try and time the market. I mean, I wrote a book, How to Avoid the 6 Biggest Blunders. One of them is trying to time the market. And this is such a beautiful chart to show people this is why we stay invested, because yeah, sure, the market might be down 8% right now, but it's up 14% overall.
Yeah. Notice all of the years that the market was down more than 10%. It's almost half.
Yeah.
But notice that the market was up, finished up in more than half of those years when the market was down more than 10%, the market still finished up.
Right.
And it's very rare that you get multiple years when the market is down in a row. The only time that happened was the dot-com crash and the subsequent Volcker, crackdown on inflation. We're not in that situation here. Okay, we do have an inflation problem. It's nothing like it was back then. Sorry, not Volcker. This is the post-dot-com crash recession that we saw. It was a pretty mild recession, but the market didn't have a sense of humor back then. So we're not in that situation. We don't have anything fundamentally wrong. And this is the great financial crisis. But again, look what happened. The next 2 years, the market was up, right? We've seen a lot of recovery in this market. And so to your point, Kelley, you try to time the market. If you look at the 1-year return ranges from 1950 to 2022, right? Any 1 year, the range of returns was anywhere between down 39% and up 47%, just on a 1-year basis. Even bonds had a huge disparity in potential return if you were just in the market for a year. So you try to time the market, these are the risks you're taking. You don't know if you're going to get minus 13 or 43, even if you're in bonds, right? And at 50-50, you've got a huge wide range if you're trying to time the market. But if you're in it for 20 years, well, look what you end up with. A 50-50 equity fixed mix, the average annual return only ranges from 5 to 14% over a 20-year period. So much healthier way to invest. And you can sleep better at night that way.
Yeah.
So I was going to wrap it up there, but I'd love to, Kelley, what would you like to talk more about?
Well, I just want to reiterate here, stay invested. I mean, usually, and I won't even say usually, 100% of the time when I put people with Advisors Capital, it's not a 6-month investment. It's a 1-year, 2-year, 5-year, 10-year type of investment. As you can see with this chart here, you've got to stay invested. Don't try and time the market because your brother, sister's cousin is going to tell you something about the market. Well, are you really listening to someone like Dr. Feeney that knows what they're talking about and really does this all day? So I love that Advisors Capital is so forward thinking. I love the positive outlook here. Inflation coming down, earnings going up, interest rates coming down. Those are all, as you say, great headwinds for equity markets. So I love that forward thinking that you guys have. I love the individual securities you buy for each particular portfolio. And she didn't go over it in depth here, but Dr. Feeney and Advisors Capital, they do have fixed income portfolios. They have growth portfolios. They have combination. They have dividend paying. They have many different types of portfolios they do for folks, which many of you on the phone call here know that, but I just wanted to reiterate that for anybody that's new here is there's a lot of different strategies we can use here. So,
what we're finding right now, given how much volatility there's been in the market, and given that people are still worried about whether there's going to be a recession, recessions, if they come along, as you can see from this chart, they often come along with a decline in stocks, broadly speaking. But what we have found is that the different offerings in the balance strategy, whether it's what we call the T3 version, T4 or T5, they correlate to different dividend yields on the equity side. So T3 being about a 3% dividend yield in gross terms, 4 being about a 4%, T5 being about 5%. We find that people select into those because it helps them sleep at night, and they recognize that getting at least that reliable dividend income is something that helps them ride out this kind of volatility that they're seeing in the market. Growth investors, as I mentioned before, they have to understand that there's a bit more of a roller coaster because this is what the market does. And we're trying to find the best growth names in the market, which often tend to be even more volatile than the market as a whole. So yeah, that's we found that in this kind of environment, balance has been particularly helpful to clients. And then on the fixed side, that hand selection we've done for credit really matters in this kind of a world where rates are high, but depends what you buy. You buy a AAA bond, you're not getting paid for it. You're not getting those interest rates that you could get if you just knew enough about a triple B and could find some good yield down there someplace.
Yeah. So to your point with that, many people come to me that are in retirement or pre-retirement, and they're looking to manage through retirement, and they need income. They need to replace that paycheck they were getting. And so for many of my Advisors Capital clients, I have that T3, T4, T5 interest rate, that percentage, let's say it's T5, that you're getting 5% on your portfolio. I have that sent to your bank account every month to help people manage their budget. And many of you I know listening to me today know that I talk a lot about budgets, and you can always get the budget sheet on my website, CaliforniaWealthAdvisors.com. I came up with a budget sheet because I've got to know what to manage too. So to Joanne's point here, Advisors Capital does have dividend paying types of security portfolios that we can just have those checks sent directly to your bank. And that's not touching the principal. Sure, the principal's going up and down with the markets, but that dividend's coming in, which I love. I mean, like, as you say, Joanne, I help people sleep better at night because I want to make sure that your portfolio is doing what you want it to do. Is it creating income, or do you looking for legacy passing? Maybe you're more interested in a growth portfolio for your children. So they offer it all, which is great. Okay,
Yeah,
anything else you want to add,
And
Joanne?
just to be aware, obviously those yields depend on market conditions,
Yeah.
right? I'm quoting you historical yields at this point. Be aware, obviously, on the fixed income side, yields are higher than that, just given what interest rates have done. And that's not going to stay around for long. It's not going to stay around forever. But for right now, it's a lot better to have some money in fixed income than it is to have sitting in cash, given the opportunities out there, and provided that you have the time and the risk tolerance even to hold on to fixed income, because nothing is without risk, But obviously a well diversified portfolio, like the one that Kelley builds for you, that includes also the alternative assets, some money in cash, right, can allow you to take advantage of what the market is currently offering.
Okay, I think that's so wonderful of you to share your knowledge here with us, Dr. Feeney. Really, really thankful to you. So any of you that have questions, if we didn't answer them tonight, we didn't get a chance to get to them, we'll get back to you with any kind of responses that you might need. So with that, Joanne, thank you so much. Appreciate your time and efforts. We'll see you on Fox Business sometime soon.
Good to see you again, Kelley, and you take care. Enjoy the summer.
Okay. All right.
All right.
Take